What if, starting next month, you received an extra $1,000 in your bank account and you didn't have to work a single extra hour to earn it? No second job, no side hustle, just money arriving like clockwork every single month. That's not a fantasy. That's what investing the right way can actually do for you. And today, we're going to show you exactly how much it takes to get there. Welcome back. If you've ever felt that quiet anxiety, that nagging feeling that your paycheck alone might not be enough to carry you through retirement, or that you're one unexpected bill away from real financial stress, you're not alone. Millions of people feel exactly the same way. But here's the thing that most people don't fully appreciate. Money, invested wisely, can work for you around the clock, while you sleep, while you're on vacation, while you're having dinner with your family. And $1,000 per month in passive income isn't just a nice round number. It's genuinely life-changing. That's your mortgage payment. That's your groceries and your utilities. That's the breathing room. That turns financial anxiety into financial confidence. This video is for anyone between 30 and 55 who is serious about building real, lasting wealth through dividend stocks, ETFs, real estate, or a smart combination of all three. We're going to break down real numbers, real strategies, and a realistic timeline. By the end of this video, you'll know exactly what it takes. Let's get into it. Let's start with one of the most classic, time-tested paths to passive income: dividend stocks. So, what exactly is a dividend stock? Simply put, it's a share of a company that pays you a portion of its profits on a regular basis, usually every quarter. Think of companies like Johnson & Johnson, Coca-Cola, or Procter & Gamble. These are businesses that have been paying their shareholders for decades, through recessions, through market crashes, through pandemics. They just keep paying. The key metric you want to understand is something called the dividend yield. This is the percentage of the stock's price that the company returns to you each year. So if a stock is worth $100 and it pays you $4 per year, its yield is 4%. The average dividend yield for solid blue chip stocks generally falls somewhere between 3 and 6% per year. For the purposes of this calculation, let's be conservative and use 4%. Here's the math. You want $1,000 per month. That's $12,000 a year. If your portfolio is yielding 4% annually, you can work backward. $12,000 divided by 0.04 equals $300,000. That's the number. To generate $1,000 per month from dividend stocks at a 4% yield, you'd need a portfolio of approximately $300,000. Now, before that number makes you close the tab, stay with me, because later in this video, we're going to show you a realistic path to get there, even if you're starting with just a few $100s a month. But here's what makes dividend stocks so compelling beyond just the income. The best dividend-paying companies don't just maintain their payouts, they grow them. A company like Johnson & Johnson has raised its dividend every single year for over 60 consecutive years. That means your income can actually increase over time without you doing anything differently. In an era of inflation, that matters enormously. The risk? Individual stocks can cut their dividends if a company runs into trouble. This is why diversification is essential. You don't want all your eggs in one basket or one sector, which brings us perfectly to our next option. If dividend stocks feel like you need to do a lot of research and stock picking, ETFs are the answer. ETF stands for Exchange Traded Fund, and it's essentially a basket of many different stocks or bonds that you buy as a single investment. Think of it like this. Instead of handpicking 20 different dividend-paying companies yourself, an ETF does it for you. You buy one ticker, and you instantly own a diversified slice of dozens or even hundreds of companies. This dramatically reduces your risk, because even if one or two companies in the fund cut their dividends or stumble, the rest of the portfolio cushions the blow. Some of the most popular dividend-focused ETFs include the Vanguard High Dividend Yield ETF, the iShares Core Dividend Growth ETF, and the SPDR S&P Dividend ETF. These funds have track records spanning decades and charge very low management fees. So how much do you need to invest in dividend ETFs to hit $1,000 per month? The average dividend yield across many high-quality ETFs falls in the range of 3 to 4%. Let's use 3.5% as our benchmark. At 3.5%, you need $12,000 per year in income, which means you'd need a portfolio of approximately $342,000. That's a bit more than dividend stocks, because yields tend to be slightly lower. But the trade-off is significantly less risk and far less research. You don't need to monitor individual companies. You set it up, you add to it regularly, and you let the machine run. And here's the long game strategy that makes ETFs especially powerful: total return investing. Instead of only buying dividend ETFs, some investors split their portfolio between dividend-producing ETFs and growth ETFs, like those tracking the S&P 500. Over a 10 to 20-year period, growth ETFs can dramatically increase the overall value of your portfolio. Then, as you approach the point where you want to start drawing income, you gradually shift more weight toward dividend-paying funds. The S&P 500 has returned an average of roughly 10% per year historically, when you include dividends. That compounding effect is the engine that builds wealth over time. Now let's talk about the investment category that has created more millionaires throughout history than perhaps any other: real estate. The classic version of this is rental property. You buy a home, a condo, or a small apartment building, rent it to tenants, and collect monthly income after your mortgage, taxes, insurance, and maintenance costs are covered. This is called cash flow, and it's the real estate investor's version of a dividend. Let's look at a realistic example. Say you purchase a single-family rental home for $250,000, putting 20% down. That's $50,000 of your own money. After all expenses, you net $600 to $800 per month in cash flow. Not quite $1,000, but close. To hit that target from rental properties alone, you'd typically be looking at either 2 modestly cash-flowing properties or 1 well-selected multifamily property. The upfront capital required is substantial, in the range of $80,000 to $120,000 just for down payments. And it comes with the realities of being a landlord: tenants, maintenance calls, vacancies. But here's the alternative that many investors don't even consider: REITs. That stands for Real Estate Investment Trust. A REIT is a company that owns income-producing real estate, and by law, it must pay at least 90% of its taxable income back to shareholders. This means you can invest in real estate through your brokerage account with the same ease as buying a stock. REITs typically yield between 4 and 6%. At a 5% yield, you'd need $240,000 invested to generate $1,000 per month, and you'd never deal with a single leaky faucet. Now, let's talk about the strategy that can actually get you there faster than most people think possible. And it comes down to one concept: reinvest your dividends. In the early years of building your portfolio, you don't actually need that $1,000 per month yet, because you have income from your job. So what if, instead of spending those dividends, you reinvested every single dollar back into your portfolio? This is compound interest in its purest form. Imagine you invest $500 per month into a dividend ETF that grows at 8% per year on average. After 10 years, you'd have contributed $60,000 of your own money, but your portfolio would be worth approximately $92,000. After 20 years, your contributions total $120,000, but your portfolio has grown to nearly $300,000. The math doesn't just work, it accelerates. The ideal strategy is to combine growth investing in the early years with a gradual shift toward income-focused investing as you get closer to your target. Let's get very concrete about what a realistic journey looks like. Let's say you're 40 years old today, and you can invest $500 per month. At year 5, your portfolio is worth approximately $37,000. Not yet generating $1,000 per month, but you're building a foundation. At year 10, you're sitting at roughly $92,000. At year 15, your portfolio has grown to around $174,000, generating nearly $600 per month in dividend income. And at year 20, you've reached approximately $295,000, right on the edge of your goal. Now, what if you're 50 years old and can invest more, say $1,500 per month? You'd reach $300,000 in approximately 12 years. That means you could be generating $1,000 per month in passive income by your early 60s, right when it matters most. So let's bring it all together. To earn $1,000 per month in passive income, you're looking at roughly $240,000 to $340,000 invested in dividend stocks, ETFs, or REITs. Direct real estate can get you there with less capital, but it's more complex. The most important insight today is this: building passive income is not about getting rich quickly. It's about getting intentional, getting consistent, and giving your money the time it needs to do its work. Financial security doesn't come from a lucky break. It comes from a plan executed patiently over years. The people who are collecting thousands of dollars a month without working for it started somewhere, often small, and they didn't stop. You can be one of those people. The starting line is right in front of you. If this video helped clarify your path, please hit the like button. It genuinely helps the algorithm show this content to more people. Subscribe to the channel so you don't miss what's coming next. And I'd love to hear from you in the comments. Which of these 3 strategies, stocks, ETFs, or real estate, interests you the most? I read every single one. Until next time, invest wisely, stay patient. And remember, your future self is counting on the decisions you make today.